Hi, Peter Jones, author, property investor and ex-chartered surveyor. And I've had a lot of requests from my subscribers and viewers to talk about property valuations and how to value property. Before we get into the nitty-gritty of that, which I'll save for a different video, I wanted to first talk about what it is that actually drives property values, because I think that's actually really important to understand before we get into the nitty-gritty of talking about how to value a specific property. Because one of the things which I hear said a lot is that it all comes down to supply and demand. And that is partly true, but it's not the whole truth, because there's other things which are going to influence property values as well, far beyond supply and demand, which we need to think about when we understand how property is priced in the market. So the supply and demand thing is right to an extent, obviously, that if there's a limited supply of properties, but there's strong demand from people who want to buy, then that will drive the price up. In a down market, when property prices are crashing, then there's usually more properties for sale than there are buyers to buy. So there's a large supply and low demand. And of course, one of the things which we need to understand when we're trying to predict, for example, what's going to happen to property prices over the next year or the next 5 years is trying to keep a tab on the trends. But it's not quite as simple as just thinking about supply and demand. You often hear the argument that, if the government made it possible for us to build 300,000 houses a year, then the market would find a balance, blah, blah, blah. What are the other things that we need to take into account? Well, there's all sorts of trends like how we live. Like over the last 20 or 30 years, there's been a big increase in the number of households looking for places to live. Now, you could say that that's part of the demand equation, and of course it is. A lot of these all overlap and they all sort of merge together, and it's quite difficult to actually sort of pull them out singly. But of course, yes, there could be demand which is driven by the fact that there's smaller households, for example, or immigration or emigration, people coming into the country, people going out of the country. All of this stuff is important. But fundamentally, this is what I think is probably one of the most important things. Now, I'm not saying it's the most, I'm saying it's one of the most, because individually we can probably look at them all as part of the equation, and you need to have all of the bits in the equation to work out what's going to happen. But the one thing which I think is really, really important is the supply of money to the people who want to buy. Because if you cannot raise the capital, if you cannot get a loan from the bank, for example, to buy a house, it doesn't matter how much you want that house, you can't really call that demand. So when the papers talk about supply and demand, there's all these people who want to move, or lots of people who want to get their own house because they're living with their parents, that's fine, but that's not really demand. In my opinion, that is desire. And unless that desire is backed by hard, cold cash, usually in the form of a mortgage, then it's not demand. It is just desire. Demand is where you want to buy a property and you can actually buy the property. So one of the most important things in property values and in driving property values is the availability of money. And really that means whether the banks have got the money in the credit crunch, the financial system behind the scenes broke down, which meant that the banks didn't actually have the money to lend. And so there was a lot of trying to stick all that back together again through central banks putting money into the system and government bailouts and all that kind of stuff. So the banks have got to have the money, but the banks have got to have the desire to lend the money. Now, one of the things which we're seeing at the time of recording this, because I'm recording this during our big health crisis, which is a worldwide crisis, is that I'm surprised at the moment that the banks are still lending as freely as they are, because this would be the time usually you would expect the banks to be fairly cautious, thinking, well, the economy is actually not doing very well at the moment. At the time of recording, GDP is down worldwide, GDP is down in the UK. We're in a recession, no doubt, possibly even a depression, some people say. I mean, the drop in GDP because of lockdowns has sort of gone off the chart. Now, a lot of that will come back, but not all of it is going to come back. Well, at least not all of it is going to come back instantly. I think we've all pretty much forgotten about this idea of a V-shaped recovery. That's probably not going to happen. So this is the classic time when you expect banks to be cautious and not actually wanting to lend. But at the moment they are. Now, I think there's probably political motivations behind that. They've probably been lent on by the government. The government bailed out the banks, or the Bank of England bailed out the banks under government instructions, 10, 12 years ago. Maybe they've been told they've got to repay the favour. Who knows? But anyway, at the moment, they seem prepared to lend. So that's one thing. The banks having the money and the banks being prepared to share that money with us, the property buyers. But of course, the next bit of that part of the equation is, what is the cost of money? Because if the cost of money is too high, it doesn't matter how much desire somebody has to buy a house. It doesn't matter how much cash is available to them to buy the house, but if they can't afford their monthly mortgage payments, they're not going to buy the house. So there needs to be the money, and the money has to be at the right price. Now, at the moment, at the time of recording this, it's record low interest rates. Bank of England base rate, 0.1%. Remember in the credit crunch when interest rates went down to 0.5% and everybody was saying, well, they'll never get this low ever again. And then lo and behold, because of everything that's happened, they went down to 0.25%, then down to 0.1%. And at the moment, at the time of recording this, there's talk about negative interest rates, possibly maybe 6 to 9 months' time. Who knows? We'll see. But even if they don't go negative, 0.1% is pretty much the lowest that the Bank of England can actually put them to. I think you just sort of blow all the sort of systems if they went to naught, so they just went to 0.1. So in theory, interest rates are very, very low. And that, of course, is a driver of property values, assuming, of course, that the banks are happy to lend and to provide money at an equivalently low interest rate. Now, they won't provide it at 0.1%, they've got to make their margin, but it might mean that whereas in normal times, whatever normal times are nowadays, they would have been charging 3 or 4%, they may only be charging 2% or even 1 3/4. I mean, who knows, I'm just kind of making these figures up. But the point is that cost of borrowing is essential as well in deciding property prices. Low cost of borrowing means higher prices, high cost of borrowing means lower prices. And it's against all of that backdrop that we need to be thinking about what it is that actually drives property prices. So what I'm saying is supply and demand, yes, but there's a lot more to it than that. So with all that said, in my next video, I'll talk about how, as a practicality, we can get an idea of what our properties are actually worth. I hope you found this video useful and informative, and if you did, then please come over to my website www.thepropertyteacher.co.uk, where you'll find loads more great property related resources, including free special reports to download and my best-selling series of ebooks, which includes the Successful Property Renovators Workshop, 63 common defects in investment property and how to spot them. And if you're just starting out in property, or if you want to grow your portfolio, you may be particularly interested in the Successful Property Investors Strategy Workshop, in which I'll take you through exactly how I started and built my property portfolio, starting literally with none of my own money, and how I built a portfolio of £2 million worth of property in just 4 years. And that was starting from scratch. I'll take you through everything that I did right so that you can copy me and do the same. And I'll also show you everything that I did wrong so that you can avoid the mistakes that I made and so that you can progress in property and be far more successful, far more quickly than I ever was. And this is based upon my own real life experience, and it took me about 4 years to actually work out how to do property investing properly. But in the 200 pages in the Successful Property Investors Strategy Workshop, I'm going to show you all of that 4 years knowledge condensed down so that you can use it immediately. And until next time, here's to successful property investing.